Hi, everyone, and good afternoon. We are hosting today a webinar on home buying for lawyers. We are very, very excited to be joined today by Cristina Sison and Rob Ross from the Sison Homes and Associates, and also the Ross Group at Intercoastal Mortgage LLC. Today, our goal is to be able to share the tips, tricks, and best, most helpful information for us as lawyers to be able to purchase a home of our own, especially in terms of demystifying a lot of the theories that are out there that would make it more difficult for us to purchase a home, given our background and our student loans and just the difficulties of the market today. So in addition to that, just some housekeeping items. We are going to be asking folks to submit questions. If you have any questions, please feel free to drop them into the chat box here on the Zoom link. And what we'll do is that towards the end, we'll reserve maybe about 5 to 10 minutes to get your questions answered. So please feel free to keep dropping them along the way. We're going to be tracking them and then fielding them towards the end. Lastly, we also want to thank everybody for joining today. We're very, very excited to have this seminar for us. We also wanted to flag some additional upcoming webinars and presentations, one of which is May 30th. It's going to be taking place at 3 p.m. Eastern, and that is going to be the upcoming solo practitioners webinar. So if you're interested in understanding how to start your own solo practice, or you have friends who are interested in starting their solo practice and trying to get a better understanding of how to engage in business development and what it takes to actually run your own shop, that would be a perfect seminar to go to. And last but not least, we are very, very excited on our 10th anniversary of the National Filipino American Lawyers Association to be hosting our very first inaugural Diversity and Leadership Conference. This is going to be taking place here in Washington, D.C. on June 23rd, 2023, and then also having a leadership development for our NFALA leaders and affiliates on June 24th of the same month. So please make sure to keep an eye out for registration. Registration will begin May 1st, and you can do so at nfala.com. And with that, we're going to go ahead and turn it over now to Cristina and to Rob with their presentation. And then also maybe Cristina and Rob, if you can start off by giving a background about yourself and just what you're able to share with us today. All right, so over to you.
Thank you so much, Gage, and good afternoon, everybody. I'm Cristina Sison. I'll let Rob say hi, Rob. Yeah, so he's my lender partner in all their deals. Okay. So so I'm Cristina Sison. I am here to help you understand and demystify some myths about home buying that you're maybe thinking about, and maybe we can tackle that together. My theme is I dream, I plan, I make it happen. So I want to make sure that I want to be able to be there on your goals and assist you in your key milestones that you'll encounter in the home buying process. I've been in the industry for 20 plus years. I've sold over 800 homes in my career. So breadth of knowledge for people who want to understand what you need to expect and what needs to be done in the home buying process. Okay, so here are the key milestones that you need to know. The journey to buy a home is a journey, of course. This is the biggest decision you can ever make in your life. It's an emotional decision. So every time you're asking, when are you ready to buy your house? Okay, when is it time to buy a house? My answer is always when it's your time, when it's your time. And to be able to do that, you need partners that will be able to assist you in the home buying journey. That way, it's not actually sort of very confusing or stressful, in the process. So hold on to the slide. So the home buying journey, we have again 9 milestones. The first milestone is, of course, building your team. Okay, I think it's very, very important to build your team because the team will kickstart the process by finding trusted experts to guide you along the way. Why is this important? Because since this is a very big decision, you should be able to choose reputable professionals in the real estate field to help you find your home, the lender that can provide you financing to purchase this property, and the title company that can perform various services related to the title of a property during a real estate transaction. So all of those parties work hand in hand in order to make sure that the process is seamless. And what you have to worry about is, what house do I want? And we can find a dream home that you want, but at the same time, you know your monthly mortgage payment, and this is a stable amount that doesn't change, because if you rent, of course, it increases. But if you know how much your mortgage payment is, then it's stable for over 30 days. You can budget much better. Okay. The next would be, of course, it's very important to check your credit score. Why? Because having a higher credit score means that you'll be able to qualify for better deals, better loan packages. However, it doesn't mean that if your credit score is 650 or 620, that you won't be able to buy a house, you know. You can still buy a house. That's one of the things that I wanted to share, that even if you have a 650 credit score, 680 credit score, it is still possible for you to make a purchase, you know. Next, please. You need to talk to a professional about down payment options. There's a myth, actually, which I'm going to share the graph, that you need 20% down payment, but you don't know that that all of the buyers in the United States, the median down payment is only 13%. You know, first-time home buyers, the median down payment is 7%, which I can show you in the graph later. But you can set a goal and then you budget accordingly. So, you know, if you actually, for lawyers, if you actually have a savings of 5%, you're good to go, you know, and I'll explain that later in your question and answer. 4, again, it's very important to know your numbers, because discovering what you can afford, we can set that amount and be able to set that budget. So for example, I wanted to spend $5,000 a month for everything. Then we can work towards that number and then be able to find your house that fits that number. But you can be pre-approved as for attorneys, because you have the high W-2s. You, aside from the tax credit, you also are able to get good mortgage rates and good loans with minimum down payment, because your loan to value ratio is good. So knowing your numbers is very, very important. After we know the numbers, right, you know how much you want to spend. Let's say I want to spend $5,000 a month. Then I come in as a real estate agent to help you, guide you along the way. We have to explore neighborhoods, your home types, determine your must-haves, what you're looking for. And it's very, very important that we do not delay that process. So it might take 2-3 months to know what you're looking for, but just do not rush on a house right away. You have to explore the neighborhoods, the home type. You want a waterfront home, you know. So this process will take a little bit longer. So if you're thinking about buying a home next year, I will try to guide you towards that, and we can already explore neighborhoods to where you want to go. You know, I think it's very important that that process is met. You know, once you are able to find the house that this is what I'm looking for, because sometimes folks have just this gut feel. You know, in my experience, people just see a house, we don't know what it is, they just love that house. If you have that affinity towards a house and that gut feel says, Cristina, I really like that house, I will have to make a CMA or comparative analysis on that house and see if it's worth it, you know, and then we'll draft the offer and negotiate with the seller. Okay, next slide, please. So it's also important for me as an agent to get an inspection, you know, and the lender will also validate it with an appraisal, because we have to make sure that the value and the condition of the home is good. Right now, the market is pretty in demand, right? So people waiving inspections and appraisals all the time, but it depends on the disclosures, what the sellers would determine, and it's your decision if you want to waive an inspection and appraisal. I do not recommend that. You know, if we can get that, taken care of. We should be able to do a pre-inspection prior to that. But I think it's very important that you have somebody at your back guiding you, because this is the biggest decision you're going to make in your life. And then, of course, on closing day, all of this process, as I said, there's 9 milestones, right? So in the 8th, on closing day, settlement, you can sign your final documentation and get the keys to your home. I make it simple as that, but you're going to be signing a bunch of papers, of course. And then the 9th milestone is you move into your new home. We'll send in the movers because it's time to make your dream a reality on move-in day. So I just want to make it simple as possible, because it's the process. They say it might be staggering, but it's not actually. If you actually make the process simple and you know the next steps of what's going to happen, this will actually guide you. Oh, okay, Cristina said this is the next step, so I know what to do, you know? So I promise to discuss real estate myths that you have in your minds right now. I'll try to answer them before the questions. So first myth is, my student debt means I won't qualify, correct? So people don't know that most of the people who buy houses have 40% of them have student debt. Okay, 40%. If they can do it, why can't you? Because, you know, sometimes they say student loans make it harder to save for a down payment. That may be true for some people who have not a lawyer's job, but with lawyers, your pay scale is so huge that Rob will explain earlier that, for example, if you have $100,000 debt, that maybe equates to about $500 in mortgage, in student loan payments. People who have deferred loans, Rob can discuss that they can also do that computation accordingly, and it's a case-to-case basis, but it is indeed possible. So they say that they can't qualify for a home because of an existing debt, but that's not true. You might be delaying without even necessarily being delayed. So I really encourage for you to sit down with Rob or a trusted lender professional that will guide you towards how much qualifying. Maybe you can qualify for an $800,000 house, maybe not $1.5 million house, depending on your budget, and that's actually a case-to-case basis. Okay, so that's a myth. Myth number 2, I need to have 20% down payment. That's not true. As I've said before, the average median down payment in the country is 13%, and first-time home buyers 7%, and some people do the 3.5% down with loan options. You can do that as well, accordingly, depends. So that's, of course, that's a myth. Of course, they say 20% will have me not pay private mortgage insurance, right? But if you have good credit, private mortgage insurance, of course, is good, because you know, it might be less than what you're thinking, you know, if you have good credit. Next screen. Renting makes more financial debt, or my financial sense. So we don't renting versus buying. With rent right now, in the DMV area, there's an increase of 17% around the DMV area in rental rates, and your rental increases and increases, and you don't put anything in your principal, you don't do wealth accumulation, you don't build equity, because what you pay for rent goes to the landlord. You're making him rich, right? So with renting, it will make sense if you know your budget and you know you can pay for this. Why don't you explore buying and start doing wealth accumulation? Wealth building equity is the biggest form of wealth building in the United States, actually. All right. With local market outlook, they say, Cristina, but where are we going to buy right now? Isn't the market crazy right now with the interest rates? But the local market outlook is actually really, really good, because of the lack of, there's a lot of demand with lack of supply. If you have the opportunity to get under contract on a house that you like, it is very, very good, because you are there's still a possibility of wealth accumulation and a capital appreciation on the properties, because if supply is low, then demand is high. What happens there, so there is a big demand on properties right now in the DMV area. But me as an agent, I have off-market properties that can also help you find your home. Next slide. Yeah. Talking about interest rates, you say, but Cristina, the interest rates is high. So we always think that if your budget is set, it's a fixed monthly mortgage payment. So it's not like renting, wherein it can increase depending on how much the landlord would increase your rate. Like as I've told, luxury apartments right now are increasing tremendously. So right now, the mortgage news daily index rate on a 30 years fix is 6.55. But maybe Rob can explain later that we're thinking about having a lower interest rate in the next few months. But let's just say 6%, 6 to 6.55% is the norm right now. Okay. So why is this important? Because when mortgage rates decrease, right, buyers' demands increase. So there's a lot of people who are looking for homes suddenly when interest rates just went down 0.5 point. Because if you see in this chart, for a $500,000 loan, that's a difference of $328 if you have a 1% increase, So you can see that that big change of savings and the qualifying amount of how much you want to buy. So before, the interest rates were at 3%, 4%, do not expect that to come back. But if you have a 6% and you know how much you want, I think that would be a good investment risk. Next. So I have sample properties lastly here. First, we have a sample property in Virginia. So this is a 1.125 million property. It's actually close to the metro. And it is definitely probably 10 minutes to DC. And for 1.125, I want to do it as a sample because certainly later when Rob talks, it's more like I want to tie in on that. Next is we have a property in Rockville, 760,000. You can get a property near Metro DC in Rockville for this price, still very good. And then the last one is one in DC. If you have the Water Street neighborhood, near the wharf, you can get a very nice place there at the penthouse level for 1.1. So the properties are still affordable. And if you're paying about maybe $5,000 to $6,000 or $7,000 in rental, consider looking at these possibilities. Yeah. With that, I'd like to turn you over to Rob and to discuss mortgage financing basics and beyond. Thank you so much.
Perfect. Thank you, Cristina. Can everyone hear me? You can all hear me. Good. Perfect. Thanks. Well, Cristina and I have known each other for a long time. And, as you are getting into the home buying process and search, as she said, you want to have the right team around you. And as Cristina has 20 plus years experience in the real estate industry, I have 22 years experience. So 20 plus years in the mortgage industry as well. I am the executive vice president here at Intercoastal Mortgage. We have the largest market share in the state of Virginia. We are licensed in 19 states nationally. I was a finance major from WVU in West Virginia and ranked among the top 200 loan officers in the nation since 2001. And we have closed 1.8 billion during that time frame and over 4,500 loans. So we have a lot of transactions under our belt. And really, I say every day, there's not a scenario I haven't seen yet, and I welcome one because I enjoy putting every single person I work with is a puzzle. And part of my job is helping you put your financial puzzle together in order to get you into a home. And trust me, every single home buyer is completely different. And it's my job to not sell you anything. My job is to educate you. That's literally, and that's Cristina's job as well. Our job is to educate you on the home buying process, not just now on a webinar, but it's our job when you sign up with us to work with us, it's our job to help you out. So as the real estate process goes for buyers here, you are, and Cristina kind of went through this earlier, so I won't go through line by line, but you are meeting with a real estate agent, meeting with a lender such as myself to get pre-approved. And that is what I stress. The most important thing is to get your pre-approval started. Search for a home. Once you find a home, Christina's going to work very closely with myself and you, the client, to determine what your best offer is and how much you want to offer. Do you want to ask for a seller credit? Is there a lender credit involved? What type of down payment do you have? What type of closing time frame do you need? Do you need to close in 10 days? Do you need to close in 15 days? Is it more of a traditional 30-day transaction, which is pretty standard in the DC area? Nationally, the average amount of time it takes to get a mortgage to closing or to close on a home is a little over 45 or 50 days. In the DC market, I did one last week in 9 days. So from the time I met a client to literally last week, from the time I met a client to the time this client went to closing, which was Tuesday, so yesterday, was 9 total days. So, and the client said they didn't want to feel rushed. I said, too late. You're already rushed. We're closing in 9 days. So, but they won the contract over 3 cash offers. So sometimes you have to move quick and you need the right team in order to do that. And then as part of the process, you can see the other lines there. We go through underwriting, we get your appraisals in and all that good stuff. So we'll jump to the next slide here. What I'm going to go through today, and I'm going to go through these slides fairly quickly in order to, one, be appreciative of your time because I know how important that is midday, and then 2, at the end, to make sure we have time for questions. So we're going to go through monthly housing and renting ratios, and we're going to start right now with monthly expenses. So basically, and there might be a few clicks here. I'm not sure if I can possibly have control over clicking through the seminar, and if not, that's fine. But what you pay for each monthly, so if you're leasing right now, let's just take your rental amount of $29.50 per month, plus your renter's insurance, plus you have some utilities. So let's say your total is $31.40 per month. If you're owning, you have $39.23. That's your principal and interest. That's your real estate taxes monthly, your homeowner's insurance, your mortgage insurance that might be associated with your loan program, your homeowners association fees that might be associated with that, and then your utilities as well. And let's just say this. So when you're looking at this example, yes, leasing is $784 less a month. But if we go to the next slide here, what you need to remember is you have tax benefits when you own a home. You have your interest, your taxes, and your insurance, which are all tax deductible. So if you have a high net worth, forget a high net worth. Let's just say you have a high income coming in, as a lot of attorneys do. You want some tax deductions, right? You want to be able to lower some of the amount that you're paying to the IRS by owning a home. So in this example, you're going to have $135,193 in write-offs over a 5-year period. That's a pretty substantial number. If we use a tax bracket, and you are going to be in a much higher tax bracket than this, but we are being as conservative as we can possibly be right here. When we are saying a 25% tax bracket, sorry to say, you're probably closer to 43, but we are going to use 25%. And when we reduce that, you are saving, you actually come into here where you're about $2 less per month because of that tax benefit. So when you subtract that tax benefit out on the right-hand side in blue, that's a $563 a month savings. So now leasing is really only about $221 less a month. But I have a little bit more for you. Forget all of that, because remember, you are paying down principal as well. So let's not lose the fact that you are paying down principal, which is $676 a month. When we add that to your tax benefit and click the next button there, you will see that actually owning a home, when you factor in all these benefits in this example, is about $535 less per month. So a lot of folks get caught up on the monthly payment in rent. And a lot of the questions I get are, Rob, I'm renting for $4,000 a month and I don't want my mortgage payment to be any higher than that. Well, now I go through an example to say it's okay if it's higher than that because you have tax deductions, you have principal pay down, you have all these other reasons why it's more beneficial to own rather than rent. And I'll just going a little off script here. I'll give you an example. Literally spoke to a new attorney who's starting in DC with her full-time job out of college, September 15th of this year. And she is going to be getting pre-approved. So she's still 5 months from starting her job, and we're already working on her pre-approval. And part of what she didn't realize was all of those tax deductions, right? She was saying she wanted to be at a certain level, but when we really went through all the numbers, she understood the true benefit of that. She did say she was hoping to maybe wait until rates came down a little bit, and we'll talk about interest rates. And I asked her what the rate was, what the interest rate was on rent. She's like, I don't understand the question. And I said, it's 100%. So your interest rate in the mortgage market, as Cristina said right now, might be in the low sixes. Well, your interest rate on rent is 100%. So I'd say 6 is better than 100%. So this is why we're trying to educate you into purchasing a home. And we will keep going here. The qualification process in general. And I'll go through these quickly. So credit history, your ability, ATR, does not stand for the American Tap Room, an old restaurant in Reston, but it stands for the ability to repay. And your wherewithal, your cash for close, your reserves, that's what we're looking at. For credit history, we and all lenders, when I say we, look at 3 credit reporting bureaus, Equifax, TransUnion, and Experian, and we're going to pull your credit score. And as we go to the next slide here, let me tell you, we're going to pause right here, and I'm going to tell you about credit score as you can kind of read some of these derogatory events. A lot of clients will call me and say, Rob, I've already got my credit verified through Credit Karma online, and my credit score is an 805. And then when I pull their credit, they're shocked that their score is, let's say, 760. Well, there's 2 different types of credit reports. There's a consumer credit report, and there's a mortgage credit report. That means Experian, Equifax, and TransUnion literally have 2 different credit scoring models. And they each have 2 different credit scores, I should say. And a lot of consumers and a lot of people don't realize that. I actually think there's some loan officers that don't even realize that out there. But the answer is mortgage credit reports are a little stricter in nature than consumer credit reports. And why is that? Well, if you're going to go get a loan or open a credit card at Target, we're going to be a little stricter if we're going to lend you $1 million than Target, who might lend you $2,000, right? So there's more on the line for us. There's more on the line for you. So the scoring model is a little stricter on the mortgage side. We'll jump to the next slide here. This is just kind of a range. Really, the only time we as a lender can't help you is when you're on the very last on the left-hand side, which says poor. And I don't know if there's a better word there, but 400 to 580, we need some help. But if you're at I should say 579, because if you're at a 580 or above, there are mortgage programs out there for you that we can help with. FHA actually goes down to 580, and FHA is actually a really good loan program. So we'll jump to the next slide here. So ability to repay is this. Most of you are going to fit right on that first line, full-time salaried employee. Maybe once you've been doing this a while and you make partner and you get some distributions each year, maybe you have some bonuses that come in on an annual basis and those fluctuate a little bit. We're always going to take your base income divided by 12 or your base annual salary divided by 12. And if you get bonuses, we're going to use a 24-month average of your bonuses. And then that's going to be your total income. And then you can see the rest of the line items down there as well. Debt. So this is all part of us proving your ability to repay. And part of your ability to repay is your debt to income ratio. What is part of your debt? This is your housing expense, other mortgage debts, installment debts such as student loans, auto loans, leases, and so forth. Your ability to repay, what payments or obligations do we not have to consider? We don't consider income taxes, utilities, food, clothing, leisure, repayments for retirement accounts. And if you have an auto lease and you don't own it and there's less than 10 months left, then we don't have to count that payment against you either. So here is a big formula, and I'm not going to read this to you, But this, other than your credit score, the second most important thing in determining what you actually qualify for is known as a debt to income ratio. And that ratio and that formula is on the right. And that is your total amount of monthly debt and payments divided by your gross monthly income. And the number to use is 43%. That is a historical number that has really not fluctuated or changed in my entire almost 23 years into this industry. 43% has always been kind of the high-end benchmark of what what their max qualifications might be. We'll jump to the next slide here. The third most important thing when you are qualifying for a home are assets, because you need a down payment. Possibly there are some options with no down payments, but let's assume you need a down payment. Liquid assets. What can you use? Again, I'm not going to read through each of these, but this gives you a bullet point, 6 bullet points of what you can use. Your own cash, proceeds from the sale of a property. You can even use gift funds from a family member as a down payment. So there's a lot of different sources here that you can use as a down payment for your new home. We'll jump to the next slide here. Non-liquid assets that we can use. Investments in securities, retirement accounts, 401k, thrift savings account, TSP accounts if you're a government employee, cash value of vested life insurance. So if you have like a whole life insurance policy instead of a term, you're going to have a cash value associated with that. You can actually use that cash value if you wanted to surrender the policy as part of a down payment. I might not recommend that, but if it means buying a home and you're okay with a term policy, we can kind of coach you up on that front as well. Unacceptable sources. There is literally something called mattress money. And in 22 years, I have actually met clients that have kept cash under their mattress, and their last name was not Soprano. There was literally a lot of folks that have mattress money, and we cannot use that. When can we use mattress money? We would ask that you deposit money into your checking and savings account, and you have to have 60 days seasoning. So that money has to be in an account for 60 days in order to use that. We also can't use proceeds from unsecured loans, stock from an unlisted corporation. I've not seen many of that, or funds held in foreign banks or institutions. And let me elaborate on that a little bit. In the elaborate, we can use it. We just have to show a transfer, and in some cases a translation from whatever currency into US currency, and then it needs put into a US bank account with seasoning. So we can absolutely use money from a foreign bank. We just have to make sure it's transferred over. And that's pretty common in the DC market. Asset holdings, like I said, we're going to look back. We're going to do a 2-month look back. And please, when you upload your documents, I had a client do this last week. They had blacked out, bless you. They had blacked out their name, their account number, their address. Basically, we just had a statement with everything blacked out on it except a balance. And we had to explain to the client that we had to actually verify things. So those are the type of things we need, not just a screenshot of your balance. Understanding the loan process, the elements of the loan, different loan options. Let's go through a few loan options here. Very quickly, very common loan structures, 30-year, 20-year, 15-year. Those are very common repayment terms. We can go to the next slide. Repayment of the loan is known as your amortization. So basically, loans are front-loaded with interest. So what that means is, if we can go to I believe it's the next slide, we'll have a little amortization table here. So there we go. So you can see in month 1, year 1 of this example, and I apologize for not changing that. I really do wish rates were back to 5%, and I think we'll be there at some point soon. But in this example, you can see the first payment, the interest is $1,250 and the principal is $360. But when you jump clear down to month 358, it's pretty much reversed. And that is because interest is all front loaded on a mortgage. So if you have a 15-year mortgage versus a 30-year mortgage, you're going to pay less interest on that 15-year mortgage because you hold that loan for a shorter period. Now your payment's going to be higher because you're paying that back at a faster rate. So just a little example of how an amortization works. Other housing expenses to consider as part of your monthly payment: property taxes, hazard insurance. Don't confuse that. It's not something that's hazardous. It is homeowner's insurance. That's all that means. And mortgage insurance is needed typically if you don't put down at least 20%. And then a lot of places might have an HOA, which is a homeowners association fee, or a condo fee. And that's a monthly fee that we also include in the payment. You don't actually pay us that. We have to qualify you using that payment, but you're not actually paying us those payments. Relationship between rate and points. And I don't know if we have any questions here on points, but I'm going to answer this. A point is a percent. So if you pay a half point, you're paying a 0.5%. If you pay a quarter point, you're paying a 0.25%, and so on and so on. A point is a percent. And we have every loan option available where you can pay right here, if you can see me on the screen, 0 points. You don't have to pay points. But if you want to pay points, you can. Now you might be saying, why would someone want to pay points? Why would someone want to pay extra money at closing? Well, if you pay points or you pay a little higher fee upfront at closing, you can buy down your interest rate. So some folks might choose to buy down their interest rate if they have a seller credit, if they have excess funds they haven't used, if they just have funds laying around in their checking account and want to pay points, they can do that as well. So a lot of this depends on that. Your rate types, you have really two types of mortgages in the industry: a fixed rate mortgage and an adjustable rate mortgage. And that's what the acronym ARM stands for, is adjustable rate mortgage. We will jump to the next slide. A component of an adjustable rate mortgage, they typically come in terms of 5, 7, or 10 years. Those are 30-year amortization mortgages. So don't think those are shorter term mortgages. A 30-year fix is a 30-year mortgage fixed for 30 years. A 10-year ARM is a 30-year mortgage where your rate's only fixed for 10 years. And then after that, it adjusts based on all those fun things that I have bullet points right there: caps and margins and a bunch of boring things that you probably don't care about. So I'll just let you read that later. But know that ARMs aren't scary. And everyone thinks, oh no, I don't want an ARM. I don't want a 7-year ARM. It's scary. Well, your payment's not going to change for 7 years. And I just spoke to you as a client and you told me you're buying this home and you're going to stay a max of 5 years. So asking the question as part of my educational process, why do you want a 30-year fixed mortgage when you're certain you're moving in 5 years? You don't need a 30-year fixed mortgage. You need maybe a 5-year mortgage, maybe a 7-year mortgage. It's a 30-year mortgage, so your payment's lower, amortization, but your rate is lower on an ARM than it is on a fix. So if I can save you $200 a month and you know you're leaving in 5 years, an ARM is a perfectly fine mortgage. Any loan I've ever had myself, I've done an ARM every time. So loan to value. Let's look at the fourth bullet point down. This is a great one. 97% is generally the highest acceptable loan to value for any type. There are some 100% options depending on sales price. It's a big myth. You do not need 20% down to buy a home. There are plenty of LTVs, or loan to values for another acronym here, or CLTVs, as you'll see on the fifth bullet point down, a cumulative loan to value if you have a second trust behind it or some sort of community program. You might get away with 5% down, 3% down, 0% down. So there's plenty of options for you right there. And we'll jump to the next slide. Let's go through types of loans and some loan products really quick. And again, I'm not going to read through all of these, but we're a full service mortgage lender. So what does that mean? It means when we evaluate your specific pre-approval, we have access to everything, whether it's a government loan, VA, if you're a veteran, USDA. If I could hand you a little prize for guessing this one, I would, but we're virtual here. But it's USDA, United States Department of Agriculture, VHDA, Virginia Housing Development Authority, DC Open Doors, right? That's a special program for DC, Maryland Mortgage Program. Typically, each state you're located in has some sort of city, county, or state bond or unique program that you might qualify for. And a lot of them don't have very strict income limits. Some of the income limits go up to a couple $100,000 a year. And so you might be surprised, even as an attorney, even with higher income, we're evaluating all of this for you. That's part of our job. Okay. We'll go to the next slide. FHA loans, very popular. And in high cost areas, you can go clear over $1 million in loan amount now. So you can do as little as 3.5% down. That's 3.5% down payment of the sales price, and purchase all the way up into that 1.2 million sales price range. And you can go clear down to that 580 credit score. I'm not sure if anyone's a veteran, but if you are a veteran or served, and you can qualify for a VA loan, it's one of the most amazing loans out there. And you can actually qualify for 100% financing with no monthly mortgage insurance, and there's no limit on how high you can do 100% financing. So at the end of 2022, we helped a veteran in December buy a $2.1 million home, and they put 0 down and they qualified. So you can do a VA loan and really have very minimal due at closing. So we'll jump to the next slide here. And there's just some examples of VHDA where you can get 97% financing and a 3% grant. So there's your cumulative 100% financing. Pretty much the same thing for DC Open Doors as well. We'll go to the next slide. Let's talk conforming versus non-conforming. Conforming loans are where you can get those 97%, 100% financing. Okay. Non-conforming or jumbo, we do have an option where you can do a jumbo loan to 90% up to about 1.25 million. But if you start getting into the 1.4, 1.5, 2 million, you start getting north of that 1.1, $1.2 million range, you do need to be prepared. That's where the myth of you need 20% down comes from. In those ranges, you will need a 20% down payment. So just something to be aware of. And the loan process. How do you get from here to home ownership? And Cristina and I have really both already kind of talked through this, so I'll breeze through this one pretty quickly. Pre-approval, underwriting, closing. With me, it's really easy. We're gonna have an initial phone conversation for 30 minutes just to talk through your goals. You're going to apply on my website in most cases. From the time you apply on my website, we're going to have your pre-approval turned around within 24 hours. We're going to provide you a copy and your real estate agent, Cristina, a copy so you can be on the same page. And then you're going to start your home search. As part of searching for a home, we're going to start asking that you upload your pay stubs, your W-2s, your supporting documents. So we can take you from what's known as a pre-approval or a pre-qualification to an approval. We want to make sure when you go in and make an offer that your earnest money deposit is not at risk, because it might be at risk if you don't perform or if you waive finance contingencies. There's a lot of things that Cristina, and why you hire a real estate agent, is working on your behalf, is making sure you don't put anything at risk. One thing I've never had happen, and I promise you will not be the first, is I've never had a client lose an earnest money deposit. So it's something we pride ourselves on. And part of what we do on that is we dot our I's and we cross our T's. And if I don't have 100% confidence, then Cristina's putting a finance contingency in there. And maybe we're only putting 5 or 6 days or 10 days. We're putting something very aggressive so you can still win the offer. But your best case scenario is you're fully approved with us before you start searching for a home. And then we can waive some contingencies and you can make your offer look a little stronger. And closing charges to the borrower. It's your purchase price, it's your closing costs, it's your prepaid items, any property taxes, insurance, all that's part of an estimate that we would provide you once you apply. We'll jump to the next slide here. Credits for a borrower. Your credit is, we're going to give you a loan amount. That's a credit to you. We're going to give you that. Depending on the competitive nature of the home you're making an offer on, maybe there's a seller credit. Maybe there's a lender credit. Maybe the listing agent's giving an incentive to buy a listing because it's new construction, and we're partners with Van Meter Homes here in Virginia. My mortgage company is, and maybe there's an incentive from them as well as the seller. So there's some different options where you might have some closing cost assistance. And the reason I'm saying might is, as Cristina said, it's very competitive out there right now. So we're not seeing quite as much of that as we have in the past. And just to give you an idea here, so purchase price $500,000, add in your closing costs, your prepaids, anything due to the seller. There's your total amount due. We're going to subtract out your loan amount of $450, your earnest money deposit, which you won't lose. That'll go towards your transaction, your seller credit of $2,000. And there you go. In this example, you'd need roughly $62,000 at closing. So just to give you an idea of how that breaks down. Once the loan process is over and you have settled and you have the keys to your new home, you're basically making your first payment. Your servicing of your loan is going to transfer over. You'll probably receive a letter in the mail explaining where your loan's been sold. All that means is no mortgage company really holds their loan. Maybe it's sold to Fannie Mae, maybe it's sold to Freddie Mac, but where you make your payments are going to change typically one time within your first 60 days. On an annual basis, you'll receive an escrow analysis just explaining what's going on with your taxes and in your insurance. And that's really it. If you refinance or pay off or sell your home, you would receive a payoff letter, so you would know what you owe. But that's really the only documentation you might receive post loan process. And that's really it from a standpoint of the seminar. I went through that pretty quickly. That might have been record speed for me. But I didn't want to bore you because I know everyone on here can read and likes to do your research. So that's why we want to provide you a copy of this webinar and seminar afterwards, and that'll come out through your company to make sure you have a copy. And basically, we want to see if you have any questions for us or for myself at this point. I know I threw a lot of information at you. This was a basic yet high level presentation from my standpoint, because a lot of you may be first time home buyers. So I didn't want to miss some of the more simple questions. But none of this is rocket science. It's all pretty easy to go through, and we've done it many times. And I just stress, if you have any thought of purchasing a home or any desire to purchase a home, do the pre-approval process. It's absolutely free, right? Yeah. And one thing I will stress too, Intercoastal Mortgage is part of a national pilot program, not for pilots flying a plane, but a pilot program through Freddie Mac. And we are one of 7 lenders in the nation. I thought it was 6, but I found out today it's 7. We are one of 7 lenders in the nation. And when I tell you lenders, there's probably 4,000 mortgage companies, okay, nationwide. We're one of 7 that allows for what's called a soft credit pool. And that means when you apply, you don't have a hard credit inquiry hitting your credit report. And not that would really affect much anyways. It might lower your score a couple points, but ours truthfully does not lower your score whatsoever. You can do a full pre-approval with my company, with myself. We can give you the keys to the car and show you exactly what you qualify for, exactly what your monthly payment's going to be, within a few $100s of the cash you need at closing. And then when you meet with Cristina to talk about your home search and narrowing down what you want to do, she's going to have a really good roadmap from us on what you can actually do. One thing you don't want to do is go out looking for homes for a weekend at $1 million when you only qualify for 800,000. And let's take the flip side of that. You also don't want to go looking at homes at 800,000 because that's what you think you want, when you realize that the payment's affordable and that you actually qualify for $1 million. So we want to really give you that roadmap to better help Cristina.
Sure. And then Rob, sorry, Gage, go ahead. Sorry.
No, go ahead.
No, I just wanted to, there's some questions in the chat that I would like to address really, really quickly. Yep. Finding the right realtor can be challenging. What are the red flags to look for? There are lots of realtors out there, but what I think would be very important is for them to be able to advise you, educate you on the houses, neighborhoods, and being honest on you making an educated decision, not because it's it's the house and you cannot afford it. We have to work as a team, all are a team wherein the affordability wise and the condition of the house, and there's so much factors that you need to have a good agent behind you doing the greatest investment that you're gonna ever make, and also it's important, a segue to that what's the benefit between a pre-approval and a pre-qualification. If you are in a in a multiple offer situation, if there's a house that's really a lot of people want, if you have a pre-approval letter, meaning Rob has already pre-approved you, and it's only subject to a ratified contract, title search, and probably an appraisal, you have a more stronger offer, because sometimes some people might offer higher, but they don't have that pre-approval letter, and you have a pre-approval letter, and I know the agent, and at the same time, you have we strategize in a way that you can get the house. Then first and foremost, get pre-approved first. And it might be 6 months from now that you want to buy, but at least you have that position to be able to plan that process. And the one that you're asking about, what's the benefit of making an extra mortgage payment each year? What can I elaborate? Well, as I've said, mortgage payment, you're paying compounded interest. So if you make an extra one payment of mortgage to your principal, let's say if your mortgage is $4,000 a month and you make an extra $4,000 a month that year, that will reduce your payment to about 8 years, and people don't know that. So if you want to pay off your mortgage faster, your principal faster, then you can just maybe do a bonus. From a lawyer standpoint, you get a bonus and you pay it off on your principal, and that will help out in getting your loan balance reduced dramatically. I hope I answered your question on that. Yeah. So and then Rob, they're asking you, how do you pick the right lender? So
Actually, so
absolutely.
to backtrack really quickly, wanted to flag something really specific, because we wanted to make sure that a lot of our audience members are lawyers. And so if we could kind of focus, then narrow the conversation to how does it apply to lawyers, that would be really helpful. So one particular question is that we know that there are loans out there that are available for high income earners like doctors. Mm-hmm. What options are there, or are there any options for lawyers when they have those types of loans as well?
Yeah, absolutely. It's a great question. And I see that here in the chat, and happy to answer that. So currently, and I will tell you this, I've done this 22 years. I've never specifically had or witnessed a specific loan for a lawyer. Okay. I always say this, there are loans that a lot of lawyers will do more commonly. That's the best way to say it. So and what those are some of the ones we've talked about. It's literally the lawyer, soon to be lawyer that I spoke to today. So ironic example, but she's got a great salary coming up. She's starting full-time in September, just graduated, ready to rock. And she doesn't have a lot of down payment saved at this moment because she's just starting her job, but she's a high income earner based upon her profession and what she's going to do. And she doesn't want to throw her money to rent. So in that case, she's going to be looking in the 1 million to 1.2 million range, and she's going to do as little as 3 to 5% down payment. So, and she's got some folks that are willing to help her out, and she saves some money herself as well. So that is more of and yes, there are loans out there called doctor's loans. So we do have those options. There are doctor's loan programs. I can tell you this, a lot of the medical professionals that come into me for the doctor's loan program, they don't even end up closing on the doctor's loan program. They close on a different loan because they have 5% down payment. We can find them a better deal that's more advantageous with a lower interest rate. So all of those are things we look at. So I would say in general, if you Google search, can you find some mortgage company in the United States that has something that they're just calling for marketing purposes an attorney's loan program? Maybe. But I bet they can let anyone apply for that same loan. So it's not specific to attorneys.
I think, Gage, also, I just wanted to point out that if you save, let's say 3% down payment and you don't have money saved for closing costs, that's when I can come in, because we can actually ask for seller help, seller closing assistance. We can put the deal together wherein we get the 3% closing costs from the seller, and then you just have to come up with the 3 to 5%, whichever your qualifying is, 3% down or 5% down options, But for higher, I think it's up to 1.1. Rob, can you just correct me on that, please? What would be the minimum for a higher jumbo?
Yeah, so right around the 1.15 to 1.2 million sales price range, you can get away with somewhere between 3 and 5% down. Once you go over that range, you're looking at the jumbo, financing, where depending on how high in the jumbo range you go, you're looking at 10% to 20% down. So all of those are options. Really, as I said on the slide earlier, your debt to income ratio is your ultimate driving factor in what you qualify for, regardless of the name of the program: a doctor's loan, a lawyer's loan, a first-time home buyer's loan, a government loan. And there's names for all these loans. They all have the same qualifying criteria: credit score, assets for closing, and debt to income ratio. 3 most important things that don't change regardless of loan program.
And then we were talking about the deferment of student debt. Do you have instances like that, right? So maybe we could explain.
Yeah. So a lot of attorneys, some fortunate ones come out of college and don't have any debt, and some come out of college and have several $100,000 in debt. So the gal I talked to earlier today she had 95,000 in, maybe it was 90,000 in debt that she's going to have from a student loan standpoint. She does not have a payment on that yet because it's in deferment. So as a lender, we use 0.5% of whatever the balance is as your monthly payment. So her payment that we're using on that $90,000 education student loan is only $450. So when she's going to qualify, and she was making, a couple $100,000 a year starting out, she has no debt. She has great credit. She has a 5% down payment, and the only debt she has is a $450 a month student loan payment. So she's easily going to she's going to be shocked when she applies today, but I told her she's easily going to qualify for 900,000 up to probably 1.1 million, depending on condo fees and HOA fees. She's going to qualify for significantly more than she really probably is going to end up purchasing at. So it's a lot of folks don't realize what they can do. And that's why we stress doing the pre-approval. As part of doing that pre-approval, one of the questions I see in the chat here says, Rob, how do you pick the right lender? I'm very biased. I could say, just call me and you've picked the right lender. But one thing I could say from picking the right lender: do your research, do your homework, just like you're going to do for your job or for anything else you do. Check Google reviews. Typically, I would say once you've met a great real estate agent, that real estate agent, if they're good at what they do, they're going to have a great recommendation for a lender for you. They're going to have someone they know, like, and trust. And you're going to look at someone's resume. Lenders I would avoid are brokers, and these 1-800 numbers and lending tree type brokers out of the Midwest. I would probably be cautious out of some of these 800 numbers where you're dialing in and you're talking to a different person each time. When Christina's writing an offer for you, it's probably happening after 5 p.m. Monday through Friday, or sometime on Saturday and Sunday. And I gave you an example when we started this of a client that I closed in 9 days last week. Well, why did I have to jump in? Because they were working with a broker that no one had heard of. They were working with someone their real estate agent never worked with, and the deal was falling apart. They were going to lose their earnest money deposit, and they were in a lot of trouble. We jumped in and saved the day in a 9-day span. We got them a better interest rate than the company they thought was the best. And they couldn't get a hold of that lender over the weekend. They literally, the listing agent called 5 times. They could not get someone on the phone. And we're available. Cristina knows if she needs me on a Sunday at 9 p.m. and we need to do something for you to win the deal, you're going to win the deal. So that's the most important part of a lender: is availability, reputation, and service. The last is interest rate. But I can tell you, if you have a lender that has the first 3 things I said, reputation, availability, and service, they're also going to have a great interest rate and tons of loan programs. So,
Rob, just one, Christina, one last question is that I know we're out of time and we're just right at that mark here. But someone also just raised the question that a lot of attorneys are also public service, and so they work for government, and they do public interest law, and so they might not have these high incomes for a lot of attorneys. And so if there's if there's other options out there, if you can make any just very quick recommendations or suggestions on where that options might be, maybe in the next 30 seconds. So Cristina, Rob, to take that.
Yeah, I can do that really quickly. When you receive this PowerPoint presentation, you're going to see several slides that I went through talking about first-time home buyer programs. such as DC Open Doors, Mortgage Maryland Program, VHDA. That's all in the slides here. And all of those go up into the 500,000-600,000 sales price range with zero down.
That's zero down.
Yeah, you can qualify very easily. The income limitations are somewhere between 60 and 100,000. So you don't have to make 200,000, 300,000, 400,000 plus a year. You can, we do loans from 0 to 5 million. So we can help you. Yeah.
You can also, like, there's an income cap of 116,000 for down payment assistance, 116,000 a year, I think. So it's very important that if you think you're just renting and you want to take advantage of that, call us and we'll definitely make a roadmap for you for a zero down payment option availability as well.
Yep. Like I started with, every loan is a puzzle, every single one. So it's our job to help put those pieces together for you. So it's unique, and we're happy to look at your individual situations.
Yeah. Wonderful. If we could just stop sharing for a moment, the presentation.
Okay.
And we just wanted to say thank you very, very much to Cristina, for Rob, for helping and sharing a very, like, a good amount of information, I think, from the home buying process. There's some good nuggets in there for a lot of lawyers, both, government and so public sector and also private sector attorneys. So I think the key takeaway here is that your situation is unique and that home buying is definitely within reach, regardless of the kind of lawyer that you are. We will be circulating the presentation, the materials, and we will also be putting this up on the NFALA YouTube site as well. And so we will be circulating that to all registered attendees, along with the presentation, in case you didn't have a chance to catch up on it and log in earlier. So with that, I just wanted to say thank you so very much to Cristina and to Rob for joining us. This was extremely helpful. If you guys can just hang on for 1 second, we want to make sure we just take a quick photo of our panel presenters and the rest of the team that helped make this